The Federal Reserve has kept the Fed funds rate unchanged at the FOMC meeting this week following 10 consecutive months of rate hikes to 5 and 5.25%. Stock markets are up with the S&P and NASDAQ both up today on Thursday in response to this. Gold is up slightly and the dollar is down close to 1%. What's next for the markets? What's next for the Federal Reserve? And how will your portfolio change this year? We're discussing these themes with Adrian Day, president of Adrian Day Asset Management and the portfolio manager of the Euro-Pacific Gold Fund. Welcome back to my show, Adrian. It's always good to see you. Thanks for being here.
Well, thank you very much for having me, David. I always enjoy interviews with you.
Thank you. It's a pleasure hosting you. So, Adrian, let's start with market reaction to what happened yesterday. Following the release of the statement at 2 p.m., the markets were down initially, but then during the press conference when Jerome Powell was speaking, the NASDAQ and the S&P gradually rose back and erased most of their losses intraday. Today, as we're speaking on Thursday, the stock markets are up again, bouncing up 70 basis points for the S&P 500. The NASDAQ is up 0.5%. Gold, which we'll talk about later in this interview, is up slightly, about $3 to 1972. I'm looking at the latest number on my screen. And the biggest mover that I'm looking at is the U.S. dollar, down 80 basis points, so almost 1%, which is a big move for the U.S. dollar. Do you have any insight as to why markets are behaving today the way they are?
Yeah, interesting. And you know, just to recap what you said, when the statement came out, which was very clear and quite hawkish, stocks dropped, gold stocked, and the dollar rose, just as you would expect. I think all markets are being a little bit over optimistic in reading a pause, in reading a dovish Powell. Powell was not dovish. Powell, in my mind, Powell was more measured, a little bit more uncertain than the statement. But I think the market has, I think it's being overly optimistic with the stocks up, as you said, stocks up, gold up, and the dollar falling. On the short term, I think it's being much too optimistic about where the Fed is going in the next few months.
So let's recap the FOMC press conference yesterday. At one point, Fed Chair Jerome Powell used the word skip to describe rate hikes, which some have said is a Freudian slip because he quickly corrected himself.
This is, if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense.
But all throughout the press conference, he indicated very clearly that more rate hikes down the line are possible. And so the question is, why not just hike now? Why pause at all? And in fact, a reporter asked him this very question. Take a listen.
Nick Timmeros of the Wall Street Journal. Chair Powell, what's the value in pausing and signaling future hikes versus just hiking now? I mean, not to be flippant, but I don't lose weight just by buying a gym membership. I have to actually go to the gym. 16 of your colleagues put down a higher year-end 23 rate today. A majority of you think you're going to have to go up by 50 basis points this year. So why not just rip off the Band-Aid and raise rates today?
So first I would say that the question of speed is a separate question from the question from that of level. Okay, so and I think if you look at the SEP, that is our estimate, our individual. It's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting. It's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so the committee thought overall that it was appropriate to moderate the pace, if only slightly.
So what's your assessment of what Powell just said?
You know, I think Jerome Powell, I'm no defender of the Fed, as you know, nor am I even a defender of this particular Fed chairman. But I think Powell answered that, and he answered it pretty well in the conference yesterday. You know, he just, in that clip you just played, he talked about level and speed, and that's a critical factor. And elsewhere in this press conference, he talked about the long and variable lags of monetary policy. We've gone from zero lower bound to 5% in basically a year, a little over a year. That is the most aggressive rate interest rate hikes ever. It's a more aggressive rate, a more aggressive pace than even Volcker. And I think it's prudent, frankly, to pause. I would have paused earlier than this. I think it's appropriate to pause to see what the effects of the rate hikes you've already done are going to be on the economy. Because as I've said before, and as I keep emphasizing, we have not yet seen the negative impacts of what they've already done. And so I think he was right. He also talked in the conference, about this being a pause. I mean, he mentioned the word skip at one point. It's funny to me, being a Fed chairman, every word people sort of pounce on. And I'm sure you, but certainly we use the incorrect word or the wrong word occasionally. But, he talked about how far we've come. And it was clear to me that he's very frustrated that inflation has not come, core inflation, which he focuses on, has not come down more than it has. The headline rate has come down, but the core rate has not. He was very frustrated in that. But no, I think it was appropriate to wait to see what the effect of what they've already done is.
Jerome Powell also said that nobody at the committee is penciling in a rate cut this year, nor does he think it's appropriate. If you look at the dot plots, certainly that indicates people are expecting, or the governors are expecting, more hikes rather than cuts this year. We'll talk about the Fed governor's economic projections in just a bit. But keep in mind that the inflation rate, the CPI level, has been steadily coming down. The latest reading was 4% for headline CPI. And it was already coming down before he had to raise interest rates, the Fed funds rate, above 5%. So the question is, why are more hikes necessary, you think?
Yeah, I mean, it's interesting, but the Fed statement was a lot, as you would perhaps expect, was a lot clearer and more forthright. We're pausing now, we're going to have more rate hikes. Jerome Powell, in his press conference, particularly in answer to questions, after he'd done his prepared statement, he was a little more nuanced, I thought. I wouldn't call him dovish. I heard some people say he was dovish. I think that's preposterous and just wishful thinking. But he was certainly more measured, if you want. And he talked about reacting. He made it very clear, or he tried to make it very clear, but the pause this month was looking at the June meeting only. What do we do now? It had no implication for what they did next month or September, because there's no meeting in August, or for the rest of the year. They were looking at what they did now. And what they did in July would depend on the data that they had in front of them in July. So he was a lot more measured, if you like, or practical than the Fed statement. But I would still say that the market, and this has investment implications, David, I continue to think that the market is overly optimistic on what the Fed is likely to do in the relatively short term. So let's say the rest of this year. Certainly the expectations have changed over the last month or two. Last time we talked, the Fed funds futures rate, the median, was for a 80 basis point drop in rates by the end of the year. Now, as we talked before the show, now that's changed a little bit. Basically, half the people think there'll be one rate hike, and a third of the people think there'll be no rate hike, or the rates will stay where they are. But I still think the market has unrealistically optimistic expectations of what's likely to happen in the short term. Again, I am no fan of the Fed. I will emphasize that. And I'm no fan of Jerome Powell. But I think we should take the Fed and Powell at their word when they think we're going to have more rate hikes this year. And look, let's face it, 50 basis point hike, that's two 25-point hikes. That's 10% of where we are now. That's not a huge increase from where we are now. So I don't think that's unrealistic at all.
You before we move on, you mentioned this several times that you're no fan of Jerome Powell and the current Fed. Why not?
Look, I think Powell, when he first came in, first of all, that pivot in 2018 was a huge error because that set his reputation. They put far too much money into the economy in COVID, and they waited far too long to pull it back. Powell had rates at zero lower bound for far, far too long. So when he started hiking rates a year ago, inflation had already been moving up noticeably, meaningfully for basically 9 months. August of 2021 was the bottom. They were 10 months after that before they started raising rates. So I think he was easy for far, far, far too long, which has made his job now much more difficult. You probably heard that old joke about the tourist in Ireland who asks, how do you get to Dublin? And the farmer says, if I were going to Dublin, I wouldn't start from here. Well, going back to June of 2022, I wouldn't have started from there. That's my major criticism of Powell.
I haven't heard that joke.
Oh, you haven't?
I haven't.
Well, sorry, pardon my Irish accent.
It's very good. Ultimately, we're going to get to the Fed's economic projections, but ultimately, I've heard this question: does it matter? At this point, we're at 525 basis points. Another 25 basis points hike. What difference does that make? Certainly, the markets, the futures, I'm looking at the CME Fed Watch tool. The futures are pricing in a 69% probability as of this morning of one more hike by July. Does this make any difference whatsoever to the economy, to the stock markets, to gold, which we'll talk about?
No, I mean, in a way, that was my point, saying that 25-point basis hikes over the next 6 months is not exactly hawkish. But here's the point. Every interest rate hike is incremental, and every hike brings more families and more small businesses to that point, to that precipice. So there's a lot of companies, a lot of households for which rates could go up to 6 or 7%, and it wouldn't affect them too much. But there's other households and companies that are barely hanging on, and a quarter of a point will make a big difference. That's one factor. The other factor that's very important, and my friend Peter Bukvar makes this point very well, better than I will. But it's not just the level, but it's if you keep rates high for longer, that in effect, that has the same effect as a hike in the shorter term. More and more companies, more and more households simply can't take one more rate hike. So the guy whose car has broken or whatever, and he needs to get a new used car, and 6 months ago he could finance a secondhand car. I don't honestly know what they are now because I haven't been in the market, but let's say he could finance it at 6%, and it's now 7%. Well, that's an $850 payment. Yeah, we can just make that $850 payment. If they raise it another 1/4%, that's an $890 payment. Honey, I don't know if we can afford that. Every small increase brings more people to the brink, more people to the precipice.
Would it be a fair statement to make that it is improbable for the average American's income to rise proportionally to the increase in the debt payments that they've experienced. Meaning, let's say, going to your example, they had to pay $300 a month in auto payments. Now it's $800. That's a 2.5 times increase. Their incomes aren't going to increase 2.5 times the next year, right?
Absolutely. There's very few households where their income is going to go up as fast as the debt payments. Now, of course, remember, we're talking debt payments. So for a lot of households, the debt payments may only be 5 or 10% of their income. So if the debt payments go up double or triple, their income still covers their expenses. But for people with higher debt levels, particularly people who need to buy a new car, or people with credit card debt, where credit card interest rates are just moving up again phenomenally. There's some interest rates, some cards, but are now charging 29%. So that has a huge impact on people with a lot of debt, no question. Now, you refer to can the income go up as fast as the debt payments? No, but I think one thing that we should look at is wages, because there's no question that labor generally in the US today does not have the power that it had in the 1970s. But there's certain sectors and certain industries where labor does have pretty high bargaining power. And if I may, can I just give you 2 examples?
Yes.
One is we just saw yesterday that the dock workers got a 4.5% wage increase. That's a 1 year, 4.5% to settle the threat of a strike. So dock workers in LA are now getting paid an average of $200,000 a year. Those wage rates are going to be sticky. If the core PCE or whatever Powell likes to look at, seasonally adjusted, comes down by the end of the year, those wage rates that the dock workers have are not going to come back. They're already set and they're persistent. So there's certain sectors where unions are strong and where we really depend on those workers. We can't afford the dock workers in LA to go on strike. Another sector that we might look at are teenage workers. And they would typically work in areas like fast food, in delivery, in restaurants, where there has been a labor shortage. I mean, all of us have seen the signs saying workers wanted. All of us been to restaurants where, there's 3 waiters or waitresses instead of 4, where, I was in a restaurant recently and they don't have a dishwasher. The waiters are taking turns washing the dishes because they're looking for someone and they can't find someone. Here in Puerto Rico, one restaurant told me they had to pay $22 an hour to get a dishwasher. I may have mentioned that before, and I'm not being condescending or anything else, but typically a dishwasher at a low level, at an ordinary restaurant, not a high-end restaurant, is not supporting a household. But you look at teenagers who are working, again, typically they are not supporting households. They may not even be supporting themselves. But the average hourly wage of teenage workers, 15 to 19-year-old workers, is now $14.89 in the US. That's a fairly high wage for people who are, by their nature, probably temporary workers, part-time workers, certainly entry-level workers.
Are you making the point that the labor market is strong in some sectors? Or are you making the point that it's these wage increases that you've observed are going to put higher pressures on inflation?
Right. Sorry, let me be clear. What the point I'm making is that there are certain sectors where labor is in shortage or where labor is very strong and wages are moving up there. Overall, I think we're seeing a deterioration in the labor market, frankly, because even though the unemployment rate maybe has ticked up a little bit, but we've had very unexpectedly high numbers of new jobs, right? But I'll point out two, which would suggest the labor market is very strong overall. But I'll point out a couple of things. One is, and there's no question that last month's new jobs was very strong. But for the last 3 months now, every time they bring out a jobs number, they revise downwards the previous month. So we're looking at jobs that are, jobs are up 7% month on month. Jobs are up 3% month on month. But that's after they've revised downwards the previous month. So you have to be very careful of that. That's one point. The second point I would make is that even though the new job creation is strong, and I'm surprised it's as strong as it is, frankly, but number one, a lot of that is labor. In the last month, the fastest growing, not in absolute numbers, but the fastest growing was government jobs. Which to me, I think we should discount. I want to see what the free market is doing. And then lastly, the point I'd make is that even though new jobs numbers are strong, we've also seen a huge increase in initial claims for unemployment. So quite a difference in different sectors, different regions, whereas the dock workers in LA are doing well, the white-collar office workers in San Francisco are doing less well, or Silicon Valley are doing less well. Whereas a teenager who wants to work can find a job at a much higher wage than he could get 6 months ago. There's other areas where, people just can't find work.
Which comes first, the chicken or the egg? That's a metaphor. Which comes first, wage growth or inflation?
I don't think the wage growth is driving inflation. This is different from the 1970s. And I'm sorry if I got onto a tangent and spent too long on it. We were talking about whether wages are going up as fast as interest payments, which they're not. But then I pointed out the wage rates are moving up fairly meaningfully in some sectors and some economies. But across the whole country, no. Across the whole economy, I don't think that wage rates are driving economy. But clearly, when teenagers are earning essentially $15 and when dock workers just got a 4.5% rate increase, and that's on top of other wage increases in the last 2 years, that alone is that alone is not helping bringing inflation down.
Let's evaluate the Federal Reserve's economic outlook. Keep in mind that they revised up their economic projections, and they're now projecting that by, the Fed governors at least, are projecting that by the end of 2023, we will see PCE inflation go to 3.2%. That is slightly down from their March projection of 3.3%. Change in real GDP, 1%. So they're expecting a 1% growth overall. That's up from their March projection of 0.4%. And they're expecting core PCE inflation, this is interesting, to fall to only 3.9%, whereas previously in March they were projecting 3.6%. So they're expecting inflation to end the year a little bit hotter than previously expected, and they're expecting the economy to grow a little bit faster than previously expected. This is in line with what Powell said, which is that we are still in economic growth. The first line of their Federal Reserve press release statement is that recent indicators suggest that the economic activity has continued to expand at a modest pace. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated. Would you evaluate this statement to be true?
Yeah, well, I'll say a couple of things. First of all, it was very clear that the Fed was focusing, and Powell was focusing much, much more on inflation than he was on the economy. And that's appropriate because inflation is the problem, and that's part of their mandate. So when you raise interest rates, they have an impact both on the economy and on inflation. And Powell and the Fed has focused much, much more on inflation, the impact on inflation. And when he talks about inflation is a lot more stubborn than they thought it was, I got the sense that Powell was very frustrated, but inflation hadn't come down more after all they've done. But he emphasized the long and the variable lags, and he talked about that with regard to inflation. But it's equally true with regard to the economy. And I don't think there was as much focus on that with the economy. It strikes me that the Fed is much more short-term oriented and backward-looking with regard to the economy. And so it's no surprise that in March, after the banking crisis, they were a little bit nervous about the outlook for the economy. Now we've gone, a couple of months without anything else blowing up, and it's an all-clear signal, and they can be a little more positive on the economy. I continue to think that the economy in the US is in very serious trouble. If we're not already in a recession, I think we will be by the first quarter of next year. You look at the excess savings have come down quite a lot. We've talked about the consumer before, the lower 50%, the bottom 50% in terms of net worth and in terms of income have zero savings. Zero. They are living from paycheck to paycheck. And as prices move up 5% and as interest rates move up, they have no cushion. If they don't get a wage increase, they have to cut back. So I think we're getting to the point with the consumer where we're going to start seeing very, very serious trouble in the economy. We're getting to that point. But we always, Powell has talked about it a lot, the long lags. And I think that's so critical for people to really get a handle on. But rates can move up, but it can take a year, 18 months, 2 years before those things really start to have an effect on the broad economy.
Right. So ultimately, Adrian, did yesterday's FOMC press conference following their statement and decision affect your investment thesis at all? Did it change the way you see the markets? Did it change your positioning in your portfolios that you manage and your outlook on the markets overall?
Yeah, I would say it's basically the same outlook, but I've become a little more cautious in the near term. I've been saying for a while that I think the market, both the stock market, the gold market, and the bond market, for that matter, are overly optimistic about where rates are going in the near term. But having said that, I still think what Powell said yesterday reinforces that and makes me even more cautious in the near term. If you look at gold, for example, I think the gold market, a lot of the chatter is about the pause and the pivot. We didn't hear much about pivot, but last Fed meeting we heard about pivot. But if we've got continued interest rate hikes this year, we've also got the Treasury refunding, which takes money out of the economy. I think both of those things suggest that gold could be soft, let's say. I'm not looking for a collapse, but it could be soft over the next several months. And when you think that most of the buying of gold, it's not come from ordinary everyday retail or small institutions, most of the buying has come from central banks, and it continues to come from central banks. China, just recently we had a report from China. China continues to buy gold, so do other central banks. You look at the ETFs, the gold ETFs, they've been withdrawals most of this year, and for the last 6 weeks, we've had net withdrawals from ETFs. So the risk is that central banks, which is a small number of players, central banks decide to pause their buying, combined with rate hikes and combined with the Treasury refunding, that could be negative. The risk is of another decline in gold, I think, in the near term.
Adrian, why is it that the gold bullion is trading near its all-time highs, whereas the gold miners, if you take a look at the GDX, for example, was about 50% of its all-time highs, which was back in 2011?
Yeah, I think there's a couple of reasons for that. If you look at the reasons that people are buying gold assets in the last year, it's mostly been for protection, for a hedge. And so people have been buying physical. So even though the ETFs have seen net withdrawals, you look at physical gold, and that is very, very strong. Not just central banks, but just coin dealers. The premiums on coins and so on are strong. So people are buying physical because of a reason they're buying gold. They're buying it as a hedge, as protection. They're not buying as insurance. They're not buying it as a speculation yet. But I think what you just said, David, even though I'm a little bit cautious on gold in the near term, and I think it's vulnerable, that's not a prediction. That's just like, what's the risk? I think the gold stocks are just amazing value right now. And if, like me, you look past the next 6 months, and this time next year, we're looking at a much stronger gold market, consistently over 2,000, you will then be very happy that you bought gold stocks today. The seniors are trading at the lowest valuation since 2017, but on several metrics, they're trading at close to their lowest valuations in 20 years. With gold at 1950, that simply doesn't make sense. It just points out how inexpensive the gold stocks are. And part of this is wrapped up in the whole, you look at the stock market. What's driving the stock market now? It's not value stocks. It's the growth stocks, particularly the tech growth stocks, and particularly the AI tech stocks. So what, five members of the S&P account for five members of the S&P account for 80% of the S&P gain this year. And over 50% of the S&P is actually down this year. So I think when we get a rotation from tech back into value, we'll also see a little bit more attention on the gold stocks, which today are actually trading like value stocks.
You wouldn't attribute the relative low valuations of gold companies to idiosyncrasies within the gold space. So let's put it that way.
That was definitely true up to 2011. We had but I think since 2011, 12, 13, we had a lot of write-offs of, the overpaying of marginal assets. So if you look at the period from 2011, 12, and 13, something like 80% of the acquisitions in that 3-year period have been written off, completely written off. If you look at the sector today, I think you have generally much better management. You have more conservative financial management. You have much better balance sheets today. I mean, the XAU is basically cash neutral today, which is astonishing for a capital intensive industry. You would expect high levels of debt. That would be appropriate. But the sector has become much more conservative in its finances. You're not seeing yet so many crazy acquisitions. The premiums generally are lower than they were, a decade ago. So no, I think it's a far, far better industry today than it was 10 years and 20 years ago.
we can't talk about gold without talking about the U.S. dollar. Historically, for the most part, they've been inversely correlated. But if you look around the world, Adrian, the Bank of Canada recently rose interest rates last week. They hiked again. The Bank of Australia signaling more hikes. And the ECB and the Bank of England are still more hawkish than the Fed. And so what we're going to see over the next year is perhaps this interest rate differential between the U.S. and all the other countries widen. Would that put pressure on the dollar downwards, you think?
Yeah, absolutely. And it's not just the differential, because obviously the Fed funds rate is meaningfully higher in absolute terms than the ECB, whatever they call it, deposit rate. So the rate differential at the moment is still in favor of the ECB, of the Fed, but it's the rate of change that matters to the market, right? And you implied that. It's the market looking forward to say what's likely to happen ahead. And as you say, with the Fed just pausing yesterday and only looking at 10% higher rates by the end of the year, so if you put it in percentage terms, it's only 10% higher. Whereas the ECB, what's the ECB, 3.5% or something like that, the deposit rate, next month's is almost a certainty for another rate hike. And the ECB, so yes, the rate of change is favoring countries around the world outside the US. And that has a big impact on the dollar. What's interesting to me is that, yesterday when Powell spoke, you saw the S&P go down, or after the statement, you saw the S&P go down, gold go down, and the dollar go up. And now all of that's reversed. And again, I think the market is being a little bit too optimistic, or I think the market is being a little bit too optimistic about, what's likely to happen in the next few months. It doesn't make sense to me that the moves we saw yesterday in response to the Fed statement should have all been reversed today. That doesn't make sense to me, frankly. In other words, if gold is up, the S&P is up, and the dollar is down by so much today. On a longer-term basis, I understand your point completely, and I think the dollar. We've seen the top in the dollar, and I think that's not certain, but that's a very high probability. And as other central banks increase rates, and the Fed is really getting ready to pause permanently, that's only going to continue.
Finally, we haven't talked about inflation itself yet. Let's close off on inflation. The Fed's projecting 3.9% by the end of the year. Is that something you agree with?
I think that's a little bit, it depends on what.
So I should specify core PCE inflation, 3.9%, yes.
No, for core PCE, that's likely, that's possible. But again, for most people, they do eat and they do use energy. So most people are much more concerned with what the headline is, not what the core is. So I think for most, let's put it this way, most people's household budgets are going to go up more than 2.9% by the end of the year. They'll be rising at a rate higher than 2.9%. No question about that.
Okay. So if we put everything together, we have potentially softening up of the economy overall, weakening dollar, and potentially softer inflation, although certain components like food and energy may stay elevated. What does all this mean for, first of all, gold and then the stock markets?
Yeah, I mean, again, I think there's a risk to gold in the near term. I don't think it's a huge risk on the downside. But if gold simply goes between 1880 and 1950 for the next few months, I don't think we should expect the gold stocks to really do much. Having said that, I think the longer term and larger risk to gold is on the upside. Because there's always a risk of something breaking, as they say. The banks in March were not expected by most people. And we can see something similar happen, whether it's with pension funds, insurance companies, or whatever, as rates continue to go up and stay up for longer. And Powell talked about that, the level and the speed. So there's always that upside risk. So even though I'm cautious in the near term, I certainly wouldn't want to be selling my gold. And having said that, if you think gold is going to be higher a year from now, the gold stocks today are just incredible values in my mind. On the S&P, we saw earnings come down in the last quarter. But the consensus analyst estimates, although they've become a little more conservative, they're still looking at less than 1.5% decline in earnings over the next 12 months. That means that the consensus of analysts is not looking for a meaningfully slower economy, nor are they looking for persistent inflation, because both of those two cut into earnings, right? Even though a lot of companies in the last 6 months have been raising rates, by and large, they have not been raising rates as much as their own cost inputs. You look at Nestle, for example, they have increased the price of the products they sell by about 50% of the increase of their own costs of the products they buy. So higher persistent inflation, even if it doesn't move higher from here, but persistent inflation and a slowing economy suggests much more than a 1.5% decline in earnings. So I think the S&P with optimistic earnings expectations, what is it today? 19.7 times earnings multiple. That's a high earnings multiple, regardless of the environment of the economy or anything else. So you've got a high earnings multiple, you've got optimistic earnings expectations. I think the S&P is very vulnerable right now.
Well, thank you, Adrian. Very generous of you to share your thoughts with us today. Where can people learn more about you and your work and interact with you directly?
Yeah, the website is adriandayassetmanagement.com.
Okay, we'll put a link in the description down below. Thank you very much, Adrian. Appreciate it.
Well, thank you, David. Thank you.